current tax revision, the effect of a capital gain on the sale of an asset. Let's assume that for accounting purposes, we had an asset that we originally purchased at 800 Rand. We have now depreciated for a period, so the current carrying amount is 400 Rand, and we were now able to sell it in the current year for 1,000 Rand. Now, for accounting purposes, our profit on the sale of the asset will be the total difference between the selling price of 1,000 Rand and the carrying amount of 400 Rand. So we will have a 600 Rand profit on the sale of the asset that will go to P&L. So 100% of this 600 Rand profit will go to our splokkie. Now, for tax purposes, obviously the selling price is the same, and the original cost will be the same for tax and for accounting purposes. However, our tax base might be different from our accounting carrying amounts because the wear and tear allowance is different to the depreciation, which means that for tax purposes, we will first of all have a capital profit of 200 Rand, which is the difference between the selling price and the original cost, and only 80% of that will be taxable. And then the difference between the tax base and the cost will be a recoupment, because the revenue services are going to say, but hang on, I previously gave you deductions as wear and tear allowance of 300 Rand because I thought the value of this asset is going to go down. So obviously it didn't go down, the value actually went up. So I want to recoup these deductions that I gave to you in prior years. So this recoupment, therefore, will be 100% taxable. So you will see now that, first of all, the capital portion of our profit will be the same for accounting and for tax purposes. So the difference between these two amounts are the same for accounting and for tax purposes. However, for over here, the difference between the carrying amount and the original cost will be different to what the difference is between the original cost and the tax base. So in our current tax calc, we start off with our accounting profit, and we have to remember that this will include the full accounting profit of 600 Rand. So the full movement from the 1,000 Rand selling price to the 400 Rand carrying amount. Now, to be able to get to our taxable income, we have to firstly make the adjustments regarding the capital portion of this gain. So the capital profit for accounting purposes was 200 Rand. The 200 Rand is the same for accounting and for tax purposes. However, the difference is that for accounting purposes, we included 100% of this capital profit, whereas for tax purposes, we will only be taxed on 80%. So what I'm doing here is I am reversing the 100% by deducting it, and then I am adding the 80% to our taxable income, because only 80% is taxable. We could have also just done an adjustment, a net adjustment here of deducting 20%, which is 40 Rand. Next, for the remaining profit, so the non-capital portion of this profit or gain, we have to firstly, for accounting purposes, reverse this non-capital portion. So that's the movement now from the 800 to the 400 carrying amount. Whereas for tax purposes, we have to put in the recoupment of 300 Rand, which is the movement from the 800 to the 500 Rand.